Boom. Okay. And all right. Hi, everybody. My name is Joe Chatham. I am the founder and managing partner of USA 500 Clubs. We are a local, regional networking organization for senior level trusted advisors. As part of our plan called the Go 500 campaign of providing meaningful, relevant, timely, and actionable advice to our members and their clients during these challenging times, we put together what we call the Practicum series. The Practicum series, the first month we did what were called town halls, which were open conversations about issues that were happening those days. And now the Practicum series are actually prepared presentations by members for the benefit of other members as well as their clients. We're having 2 a day every Wednesday and Thursday right now through, I believe, July 22nd. And they've been quite meaningful. The one today that you guys have all been invited to and are participating in is called Unprecedented Times, Unprecedented Opportunity, Time to Plan for Your Family Business. We have 3 great presenters on the phone call today. And please, so we have Danielle Justo with Rich May. Danielle's a terrific member. She's in leadership in the organization, is the club development director for our Power Lunch group, is a trust and estates and real estate attorney, a great resource. We have JG, AKA John Gassman. He is a member down in our New York Wall Street group. JG is a sophisticated wealth advisor, back-end accountant, and has been with his firm as approaching, I believe, a 100-year-old firm, and it was started by his grandfather. JG is a terrific resource to his fellow members. And then we have Mark Bernstein, who is also in the direct accountant, does accounting and tax planning. Mark is a member of, oh gosh, Mark, all of a sudden, you're MTE too?
Midtown West.
Midtown West, I'm sorry, of the Midtown West Club. All 3 terrific members. All 3 are going to provide you some great information. And with that, I'm going to hand it off to them. I'm going to make sure that everybody, Stephen, just to let you know, I'm putting you on mute as well. So everybody should be on mute. If anybody wants to speak, the only thing, or if you have a question, down at the bottom of your screen, you'll see a chat box. If you drag your cursor down to the bottom, you'll see a chat. And you can open that chat and you can direct questions. Just direct them. If you have a question that'll benefit everybody, you'll just click on everyone and I'll read the question, or if the presenters happen to see the question, they may address it directly, but we will keep track of the questions. We're going to ask that you hold the question. We're going to hold the questions off till the very end. This will go for approximately a half hour, at which point we'll open it up for Q&A, and our presenters will address it at that point. So with no further ado, I am going to present, I believe Danielle Justo starts off, or is it Mark?
Actually, JG.
Oh, JG, okay.
Well, thank you, Joe, for that wonderful introduction. As everybody knows, the coronavirus pandemic has dramatically impacted probably every sector of the economy. Media outlets have talked a lot about the travel ban, family businesses, all kinds of businesses that are just impacted. And when you think about the economy, I was reading the other day, and I just pulled up the article, roughly 64% of the U.S. gross domestic product and 62% of the country's employment comes from the family business. And with all of this affecting us right now, there's no time to start beginning to plan for a family-owned business. Challenging times like this, there are golden nuggets to be found. So with that said, we're going to talk a little bit today about where are the opportunities, what are the strategies business owners, advisors should be thinking about for their clients. Mark, can you advance the slide? So as you know, we have 3 wonderful people. We have Mark Bernstein, he's a CPA from Katz, Saper & Miller. We have Danielle Justo. She is a tax attorney, very, very knowledgeable in wealth transfer techniques. And then we have myself, John Gassman, talking from the position of a financial advisor. And I think the three of us all agree that when you combine the 3 or 4 professionals working together harmoniously and collaborating for the benefit of a client, great results occur. And as we said, the 3 of us look at things from a very different perspective and see things from different eyes and lenses that will result in different ideas for clients. So let's talk about why now, where's the opportunity, why should people start thinking about gifting? Mark,
Good.
or is it Danielle?
One more slide, Mark. Why now? Thank you, JG. I had some clients call and say, I'm quarantined, so I'm starting to look at my estate plan. Hopefully look at it before then, but a lot of people have had the time now to look and evaluate their goals, and some of them have shifted. And so now is the perfect environment, because there's 5 factors that make this a good time to gift or just do your succession planning in general. Right now, business interests and other asset values may be very low, maybe the lowest that you'll see in your lifetime, hopefully not. And the revenue is very low for your company. So either your tenants aren't paying rent, or if you're a business that's been shut down, you can really get a lot of value out of your estate and onto the next generation at this time. So we don't know what lies ahead financially, but we do know right now that taxable income is expected to be lower, and we have a really favorable regulatory environment. And we'll see from the next slides that the exemptions are at an all-time high, and we also have what's called the annual exclusion, and interest rates, which will be coming up also another slide, are very low. So that will allow us to do some go back one more, interfamily gifts. So with the exemptions, as you can see from this chart, 2017 is 5.49 million. So that's the amount of value you can get out of your estate over your lifetime. And you can do that as a gift, or it'll be exempted on your death. And right now, though, it's up to 11.58 at an index for inflation. So this is that was a tremendous jump over the last few years. And guess what, guys? In 2026 in January, it's set to go back to the 2017 rate. So what we're telling a lot of folks is, take a look at this, and then take a look at the right-hand column. We can also, as we'll see in some of the case studies, we could also get $15,000 per spouse, per child out of your estate annually. So that combined is an amazing opportunity to get the value out of your estate. So also in November, the IRS gave some guidance that there's going to be, if you take a look at the bottom of the slide, no clawback on gifts that are between that 5.49 million and that 11.58 million. So they won't go back. If we gift 8 million per se, they're not going to go back and capture that difference. So now if we look at, if you've used all of that lifetime exemption up, if you go to the next slide, Mark, you can see that we could also do some interfamily loans. These are the rates for the this applicable federal rate that we use on the notes for the interest on those promissory notes between family members. So we can give away stock, and then we can also sell stock to the next generation. And look at that AFR, 0.435%. That's the number to beat versus appreciation of those assets. So you can, Joe, will we be able to shoot these slides out to people afterwards? That will be a good thing for you guys to have. And now Mark's going to talk a little bit and start going into some case studies.
Yeah, thank you, Danielle. As Danielle mentioned, I would say probably in March, not so much, but starting middle of April to May, been having a lot of conversations with clients that, they finally got over that initial hit of the pandemic and what's life going to be, spending time with their family. Many I've talked to, they have 3 generations living in their house right now, and they're trying to deal with all that. But they're saying, what can I do? What can I do for my family? What can I do for my community? Those things are on their minds, and they want to figure out how do they deal with this. So first, what I have done is you kind of talk to them about what assets do you have, who do you want to take care of, do you have some assets you think you'll never think you'll ever need to use, and what are some of your options? And you could either do it at your passing, which is a good thing to do if you have a lot of assets, that you don't leave it up to the states and the state rules that tell you how your assets will be divided among your heirs. You take your own choice of who you want to be beneficiaries of your estate. So you go through that process, and in many cases they say, I got quite a few assets that I don't think I need, but maybe I wouldn't mind keeping those assets, but I'm okay with all the growth going to my family. So there's some strategies we're going to talk about here in a little bit that can talk about real world cases that we've all have worked on, where clients, we had these dialogues and we came up with a solution for them. And a couple of things as we go through the lifetime that I found that they really have liked about doing lifetime gifts are, one, when you do a lifetime gift and give out the appreciation, the government will never get estate tax or gift tax, generally speaking, on that appreciation on their death. So they think that's really cool because very few people want to pay government any taxes. So they love that opportunity versus if a state in their estate and they hold it until their death, they're going to generally pay estate tax. And it's on a chart that we had earlier, that's at 40% right now. Another thing they really have enjoyed, especially I've seen as younger generations, I guess, is they want to see their family members enjoy some of it. I think that maybe is a little generational, maybe not, but they want to get assets in their family's hand, maybe have some control to it, but they want to see them buy a house, buy a car, raise their family, go to good schools, bad schools, but have education, and they want to do that. So they're really liking that. We're going to be focusing today, when we go through the case studies, we're going to be focusing on generally federal tax rules. And as Daniel put up, was those were federal lifetime exemptions and federal gift annual exclusions. But we all have to be cognizant of the fact that states also have different rules. And when you're thinking about any plan that you put together for your family, for your community, states might look at it very differently. There's about 12 states, I think, that have gift tax rules. And then there's other, I think it's 30 some odd states that have estate taxes, but they go in different ways. I know New York and Massachusetts also have rules you have to think about, but it's really beyond the scope of this presentation today. But I just want us all to think about that states are something else to be think about, and also location. Where are the trustees? Where are the beneficiaries? Where are the assets? And they all could play into the analysis. So I'm controlling. I have to figure out how to do this. Okay. So what we put together is, how do you do it? So now you had the conversation with the client, the individual, and say, I'm in. I want to do it, but I have no idea how we do this. So what are some of the tricks of the trade that some of the techniques that you think would be helpful, or things I should be evaluating? And we just listed a few of them. And in each of these cases, there's variations of how you can deal with each one of these. And the case studies that we're going to do, we're picking one of those ways of doing it, and it's based on how our clients chose to go forward. The first few of them, the family freeze partnership, the grantor retained annuity trust, the family business transfers, I kind of call those more freeze techniques, in which the senior family member says, I want the assets. I'm okay with the assets I have. I want possibly an income stream off of those assets. But please give the assets away to my kids if we can figure out, or my grandkids if we can figure out how to do that. And then if we go down a little bit further, there's charitable remainder unit trust and charitable lead annuity trust, which I kind of view those a little bit of, you want to get back to community, get back to charities, but with proper planning, there's also another bite of the apple that you can give to your family member. And I think JG, when he goes through his case study, he will kind of show you how you can get the benefits to a charity, but also keep some benefits for the family as well. And that is very exciting for a lot of people when you do planning. And then a couple things on the bottom, the intentionally defective grantor trust, the lifetime exemption we talked about, the annual exclusion. I kind of call those how you soup up your gift. Those analysis, they help you get a greater bang for your buck, right? If you can give a gift, not pay tax, get appreciation out, your family will get more assets. For example, if you got $1 million out of your estate that grew to $5 million, if you kept it in your estate, just assuming a 40% estate tax rate, if you passed away with it, government would get 2 and your family would get 3. If you did one of these techniques on the same example, your family would get all 5. So there's a really powerful if you do some of these techniques. So the first case study that I want to talk about was, I had a client that she's the senior family member. She's about 72 years old. Her husband passed away, and she feels very comfortable where she's in life, but she always is worried, right? I still would like my assets, but I'm willing to give up all the appreciation. And we talked about all the facts with her. How can you keep the benefit of that asset, get an income stream, but give away the appreciation? And what she loved was the concept of putting the family business into a partnership. She still controls and manages that family partnership. She takes back a preferred interest in that partnership and a common interest. And with the preferred interest, you have to make sure that the interest stream you get is a qualified right, and we dealt with that. And then what she did is she used her lifetime exemption, and she gifted the common shares to her family members. That she actually did it direct to her second and third generation, and she used her lifetime. And because they had an interest that was behind the preferred, and they were non-voting minority position marketability, we were able to take discounts. So in all these cases, we had to add a couple more advisors that we don't have part of this team today. There was appraisers. One appraised the preferred interest on what was the right return, and the same appraiser also said what the discount would be on the common units that were transferred. So we checked all her boxes. She got the assets still in her name. She got her income stream off the family business, and then all the upside will go to the family. And once again, she's assuming the family business is going to grow, and if it does, a lot of wealth could be transferred to the family. The next case study, the next case study I had was a client that was in March he was watching his family business, which is publicly traded. He watched the stock go down tremendously, gut checking, wrenching, but he knew the stock in his mind was going to go up substantially. So we talked about where he is in life, what he wants to do. We said, let's talk about a GRAT. And generally speaking, what a GRAT does is you put assets into a trust. The senior member gets those assets back plus a return. And in this case right now, it's 0.6%. And any upside goes to a family, and this is over a term. The one thing you have to do is you have to outlive it that make the GRAT work. So in his case, what he did in late March, he put $5 million of stock into a GRAT when it was trading at about 50 bucks a share. And right now it's trading at 95 bucks a share. So if he outlives the GRAT, we ran this analysis at 7% return, $1.2 million would get out to the family, and that would be gift tax free. They will never pay tax on that. And even the beauty, what he also did is he decided to put it in a intentional defective trust. And what that does is it allows for income tax purposes, it's him. So he's going to pay all the income tax on all the income that's earned by that trust. So it's a gift that keeps giving. So he's pretty excited right now. You know, the stock has to keep staying up and not go back down, and he has to live another 5 years. But if so, a tremendous amount of wealth could be going to his family.
Hey, Mark.
Yes.
So one thing, and I love this technique, it's probably one of my favorite go-to techniques nowadays, with the interest rates being as low as they are. As Danielle said, the AFR is so low. It's the lowest that it's ever been in years. We've been looking at using this as a vehicle for just publicly traded stock. When the market corrected right back in March and April, we've had clients that are sitting on boards that take their company stock as getting permission from their company to allow for the transfer into a GRAT. And we have seen, as evidenced by the market, the stock market rebounding over the past couple of weeks, they've gotten all this, as long as the stock price maintains that level, they're going to get a lot of appreciation out. So this is definitely a technique that I think is often overlooked. It goes beyond just the family business, but it's publicly traded stock and other assets.
Sure.
So I really, really like this technique as something, and I think it's something that's not used enough.
Yeah, and the beauty, and I don't want to take too much time, is it really costs you very little to set up, because you just have to have a GRAT agreement drafted, which is not too expensive, relatively speaking. And if it doesn't work and the stock doesn't go up, it's no harm, no foul. The asset just goes back to the grantor. And if you go up like JG just spoke about, and in the case of this particular client, he almost doubled the money out of his estate at this point, but he has to wait until the term of the GRAT is over. So we'll see. I love it too. The government doesn't like short-term GRATs. They're trying to push GRATs to be 10 years versus shorter, but they haven't been successful in the current administrations.
Now, Mark, I just wanted to mention, we were talking about the other day, I had some clients who work this out with a GRAT, and the real estate, publicly traded stock is a better vehicle, a better gift to make than the real estate, because the real estate being illiquid. Now, you were mentioning that you bundled together these assets, and that was less cumbersome.
Yeah, absolutely. Danielle, what the point is, you have to value the asset when you put it in. And when the asset goes back out, you have to value at that point. So when you put an asset that is a business, you have to give valuations each time. So it makes it more difficult. So when we've done that, when we put like a real estate or a trade or business into a GRAT, a lot of times we put other assets in there as well that allow you to pay the annuity.
Thank you. So what I found, if you advance for real estate, better than the GRAT with this asset, is an LLC, and I love working with LLCs. So this example this is a wonderful example, because this was a century farm, so a 100-year-old farm that the family turned into a real estate development. And the senior family member, it can be more than one members, we transferred their asset, which was in a trust. So it can be a trust, or it can be in their names. And you take a look at that and you say, we can do this better. We spin out the real estate into one LLC, and that's a real estate holding company. And then we spun out the operations into an operating LLC and did a ground lease back. So the beauty of that is you have the limited liability protection, which you didn't have before. And then in those operating agreements, we have wonderful techniques of putting in more protections. And some of those protections are based upon the buyout provision. So if you have a buyout provision in either one of these or both of these LLCs, if there's by operation of law, a transfer of the membership interest, then what happens is the divorcee or divorced spouse or something, or the remaining or surviving spouse would have the company buy it back because they have a right of first refusal and have a note. So a lot of times that keeps this asset out of the marital estate and out of the divorce, and stays in the bloodline, which is a lot of what the senior family members want to see. The company going to the next generation and then the next generation in the bloodline. So we can do that with the LLC operating agreement. We also have provisions in the LLC operating agreements to allow for the annual exclusion to be used, which, if you remember the nice chart from above, we have a $15,000 annual gift that we can make, equaling to the amount of membership interest to each child from each spouse and the senior family member spouses. So that gets more value out of the estate. And what I like to do is to do them in December and January. Do one gift in December, one gift in January. Use some of the lifetime exemption, which is that $11 million figure now per spouse, and use that $15,000 annual exemption, and then use that same appraisal or that same valuation in January and do an additional gift. And that gives more bang for your buck. When we do these transfers, and you have to do obviously the proper documentation, crummy notices, et cetera, for the annual exclusion, gift tax returns with mark for the lifetime gifts. We're getting that down to the next generation, which makes that senior family members feel much more comfortable, is having that this next generation have a voting trust in place. And all that does is allow each branch of the family, in this situation we had 3 branches of the family, and have that branch of the family vote as one branch. So this way, when you have to make major decisions, they're not so cumbersome. We have one family member, one member of each of the families sitting at the table saying, okay, now we're going to sell, or now we're going to get a management company in. So this is a gift. That was the gifting on the prior slide. And now this is the same example, same situation, but let's say your senior family members need an income stream. So what we can do from one of these LLCs, if you look at the top arrow, is sell some of the membership interest and take back a note. So this way there's an income stream for payments under the note. And with that AFR being so low, we really get a lot of value out at a low interest rate. And so that's, there's a couple different, this allows you to do income flow, and there's another couple of reasons for this. And also you could use up a lot of value of your lifetime exemption and not have any more left. And so that's why you might want to do the note to get the rest of the value out of your estate. So like I said, this works very well. We put, there's a lot of bells and whistles here, but they all make sense, and they do give a lot of comfort to the senior family members.
Well, I guess it's my turn, and this is what I call the happy plan, because it makes the founders of the business happy, and it's going to make the children ultimately very, very happy. And regardless of your plans, sometimes succession planning takes a different road than originally thought of. And take myself, for instance. I'm a 3rd generation firm, close to 100 years, but I'm going to tell you, we're not transferring to the 4th generation. Why? Because my kids have different plans of what their futures are going to look like. That doesn't include working for me, for the family business. So if the kids don't want the business, the default decision by the founder or mom and dad or the owner is often to sell the business either to an outside party or to look for internal succession via the employees. And let's face it, the family business is not always meant to stay in the family bloodline. And that creates the need for efficient exit strategies to be thought of in order to monetize the asset and at the same time protect from the various invaders. And when I say invaders, let me just mention the invaders that I'm thinking of for most people is Izzy, Robert, and Sam, the IRS. Nobody wants to pay income taxes or estate taxes. And the second set of invaders are protecting the money in the family bloodline, divorce, lawsuit, and other various creditors that you may come across in your dealings. So in this particular case, let's just say the client has a very significant net worth resulting in a taxable estate. And he is concerned that we're going to have a regime change in the government. New estate tax laws are going to be put in place. The 11 million is going to disappear, and his kids are going to be left with less money than they would have been had the estate taxes remained in place. So the kids aren't coming into the business. He and his wife want to typically maximize the sale proceeds, maximize cash flow in retirement, leave the bulk of their wealth, their estate to the family, while at the same time keeping a keen eye on minimizing the taxes. So they want to use their $11 million exemption in whichever way they can. And I'd ask everybody on this call, who doesn't like this plan? Maximize wealth, leave the biggest legacy, and screw the government. I think everybody wants to do that. I hope there are no IRS agents on the phone here. Anyways, through the planning, what you'll see is effectively integrating traditional estate and financial planning with the element of a charitable planning technique. It really makes it possible to increase the lifetime benefit to the owners, the increased benefit to the heirs, reduce income and estate taxes, as well as increasing gifts to society, I'll call it. So after collaborating, this client, after collaborating with, let's say, Danielle, the estate planning attorney, and Mark, the CPA, myself as the financial advisor, the recommendation was to sell the business. And not just sell the business outright, but to sell the business using something called a charitable remainder trust. And those come in a lot of different flavors. It's like vanilla and chocolate. We have Kratz and we have Krutz, and I'll get into that. And at the same time, to hedge the transaction, not only will the charitable remainder trust sell the business, but will hedge the transaction with the use of something called a wealth replacement trust. So they collaborate, they decide this is the way they want to go, and the decision is ready to pull the trigger. So the CRT, or the charitable remainder trust, is an irrevocable trust. It's a split interest trust. It's going to generate some current income. And at the end, the remainder of what's in this trust will go to charity, a public charity. You don't want to set up a private foundation. That's going to inhibit the way this works. So you usually set up your donor advised fund, or you'll name, let's say, the New Hampshire Community Trust Fund. I think Richard Peck's on the line, so we'll give him a shout out there. The first concern I always hear from a client is when we talk about charitable trusts is, I'm not all that philanthropic, JG. Why would I want to do this? Why would I want to give my money to a charity? I want to leave it to my kids. And the answer is, we're all philanthropists. One way or another, you, me, Joe, everybody on this call is a philanthropist. We're either voluntary philanthropists or involuntary philanthropists. Involuntary philanthropists, they pay taxes. Voluntary philanthropists figure out tools, techniques, tricks to give their money away, but not to the government. Remember, the government is going to take your money, they're going to pay off the national debt, they're going to use it for Medicaid, Medicare, variety of social programs. But wouldn't you rather decide where your money goes? So we're all philanthropists. And as another colleague of mine who's on the line, I see, Mike Fliegelman, would say, if you're willing to plan a gift, the government is willing to forgive a tax. Because if you give away all your assets to charity, there is no tax. That's less money the government has to pay for social needs. So in this case, we've collaborated with the parties. We've gotten everybody together. We make the decision. We're going to sell the business. Here, the family, the senior family member, he's going to take his $13 million asset or business. He's going to gift it to a charitable remainder trust. And we're using a CRUT, a charitable remainder uni trust, rather than a CRAT, because he wants higher payouts up front rather than a fixed, consistent payment every year. And again, I have to point out, a charitable remainder trust is irrevocable. Once you put the asset in, you cannot take it out. You can't move it out. So what'll happen is we transfer the asset into the CRT. The CRT enters into the sale arrangement with the potential buyer. And at the sale, it creates no income tax whatsoever because the charitable vehicle is a tax-exempt organization. So that's number one. There's no tax at the sale. Goal number two, the client wants to save on taxes. Well, what happens is when you contribute an asset to a CRT based on the formula and the calculations, you also pick up what's called a charitable deduction. And in this case, the $13 million gift into the trust based on the assumptions of a 9% payout, 4% hypothetical growth rate, 30-year life expectancy results in a $1.6 million immediate charitable deduction for the family, for the business owner. And again, we're going to move this over a 30-year period. So what'll happen now is there's more money inside of the CRT. There's 13 million versus after tax 9 million, which is going to result in a $1.1 million payment in year one to the family member versus having to.
JJ, I just want to remind you, it's 10:37. There's a Q&A session that follows, and then the whole thing ends at 10:45. So just a quick reminder of the time.
Terrific, thank you. So the goal is with this that what's going to happen is upon that transfer, the client will now end up with significant cash flow coming in. And if he died, unfortunately, because he chose a life expectancy, that asset is gone from the estate. So we hedged, and this is concern number two. They're not philanthropists. Concern number two is what happens if I transfer the asset and I die? Well, if I die, the family loses the asset. So we backed up the transaction with the purchase of a $10 million life insurance policy. So if he dies, you're going to see what happens is the kids end up receiving $5 million each, tax-free, estate and income tax-free, that's going to be inside of a trust for their benefit that will continue to pay them for a period of years, protecting them from taxes, eroding factors, so on and so forth. So this is a very, very unique tool that allows people to decide if they can't just gift it away to the kids. This is the vehicle that you may want to consider for a sale because it checks off a lot of the boxes. Cash flow, reduced taxes, benefiting a charity and family at the same time. So highly recommend this as a unique vehicle for transferring wealth and using today's economic environment to pass it on to future generations. Let's go to, let's skip the next slide and just start summarizing where we are. Obviously, again, as the title said, unprecedented times, unprecedented opportunities through the tips, tricks, tools, and resources that Danielle and Mark bring to the table. There's no time like now to start planning for the family business, whether you're keeping it, whether you're transferring it, whether you're selling it, no matter what, this is the time. You know, the adage is you buy low, sell high. Well, a lot of people miss the opportunity in the market, but with the family business, this is the opportunity. We have never seen, as Danielle said, we've never seen the AFR as low as it is. The exemption is as high as it is. We can expect taxes are going to increase. We can expect that there will be a regime change. We can expect so many changes. Don't lose this opportunity to work through gifting strategies or wealth transfer strategies for you, your clients, friends, and colleagues. That's kind of my pitch to everybody is don't lose the opportunity. It's here. If anybody has questions or comments, on the next page we have Danielle's contact information. As I said, she practices for law for the Rich May Group, estate planning, transfer wealth planning. Mark is a CPA. He's got expertise with family-owned businesses like no other. He understands the tax considerations that one, and he's wonderful with clients. And then myself for strategizing and exploring different vehicles, methodologies, and tools that one can leverage in today's environment. Let's open it up for some questions and comments with folks, see what we have. Anybody, Danielle or Mark, any additional thoughts or comments?
Danielle, I just someone had asked on the call just to identify what you meant by no clawbacks.
Right. So if you take a look at the slide with the exemptions, right now we're at the 11.58 million index for inflation. So in 2020. So what's going to happen is in 2026 in January, we'll be reverting back to the 2017 level index for inflation. So you've got this differential, and if we give away now up to the $11 million exemption, even though it's going to revert back in 2026 to the 5 million, that difference of of approximately $6 million is not going to be clawed back into your estate. So that gift is done, and that and all the appreciation that Mark talked about is out of the estate. In November, folks were worried about this, but in November, the IRS said, we're not going to claw back that differential. So you've given that away. It's out of your estate and you don't have tax on it. So
if you give it out December 31st of 2025,
yep.
you're good, even though the next day it changes.
You go over the 5 million, yeah, you're still going to, you have given that away. So you're not going to revert and get taxed on your death or at any other time. Now, we don't know, like JG said, what the new, what new legislation is going to come. It might not revert to the 5 million and change. It might go lower depending who's in office. So if it reverts back to one of these other numbers, they could change that. That's just the provision that it's set to revert to automatically. So it really is the time the government and the regulatory environment, as well as coupling with the annual gift exclusion, the tax provisions are really perfect to do this gifting now. And then if you run out of those gifts, let's say people don't listen to you and they miss that opportunity. You tell them about the clawback and they still miss that opportunity. You could always, and you use up that lifetime exemption of the 5 million and change, you could always do one of these notes that we're talking about at a very low, very low AFR. So there's a couple different ways to skin the cat, so to speak.
Terrific. If you would, on that, Mark, go ahead to the final screen that shows everybody's contact information. I just want to make sure that the guests on this webinar understand that you have some terrific resources available to you. We did a lot of information in a very short time in the interest of everybody's time. But these are 3 great resources. They all have tremendous resources available to them through their own contacts as well as USA 500. We were proud to be able to have you guys speak today, and I hope that the people on the call benefited from your knowledge. We will provide a copy of the PowerPoint deck. We will send it out to everybody who's registered on the meeting. And if you have any questions beyond that, please do not reach out to me, because I would get you arrested. So reach out to the pros. Use these phone numbers. They're the best resources that you have available to you. And with that, unless there's any last question or any last questions, I will go ahead and close out this meeting. So just I don't see anything on the chat or anybody raising their hands. Okay, terrific. Thank you guys very much for your information, and thank you for sharing with everybody.